Welcome to episode 15 of Auction Watch, the show where we deep dive into properties coming up for sale at auction. I'm joined today by our auction supremos, Jay Howard and Omer Mehmet. And today we're going to look at a Santander branch in Bexleyheath, a flat on a very short lease, 14 years remaining in Surbiton, and also 5 studio flats above a shop in Kilburn. If you're new to this channel, make sure you subscribe and hit the bell icon. We put out new videos all the time. You really want to keep informed when we release. Smash that like button and tell us what you think. If you agree with us or disagree with us about what we are talking about, let us know in the comments below. And if you've got any questions, also fire them in the comments below. So first off, Santander in Bexleyheath. Omer, what's all this about?
Right, so this is lot 23, or is that 33? 23. It's Bexleyheath Broadway in the Allsop commercial auction, and it's partly let to Santander. The other part is let to a Chinese acupuncture business, and then you've got 4 residential 2-bedroom flats on the uppers. So guided at 2.2 to 2.3 million and currently producing an income of 167,000.
So the upper parts come with it? They're not sold off on long leases?
Yeah, it's completely,
the whole
freehold. Very busy Bexleyheath Broadway, if anyone knows it. Thriving Broadway still. You don't see many shops come up for sale or rent down here, to be honest with you. So very desirable location. But yeah, so the income that's being received at the moment on the lower end of guide is a 7.5% yield. And we've seen lots of these Santander branches come through the auction recently, and we've seen some of them achieve yields as low as 4%. So it seems to be guided low, I feel. The seller has also put a CGI for another floor to be added on the top of the building to create another 2 flats. Now there is no planning permission for that, and that's purely a hope value. I haven't explored the potential permitted development rights to add that floor on and whether that is possible to do that. However, one would guess that the building to the right hand side, which is occupied by Halifax, seems to has got that footprint already, so that could be a good starting point, I suppose. But in terms of the tenancies, you've got Santander. They're occupying the majority of the ground floor commercial unit, and they are paying 70 odd thousand in rental income, and they've just renewed not too long ago in middle of 2021. They've renewed for another 5 years, fully repairing and insuring lease. And then you've also got a longer lease, I believe. We've got a longer lease to the business to the right-hand side expiring in 2032 and producing an income of about 38,000 from the acupuncture business.
Well, it looks actually, I think maybe it's a little bit too close, but I think the acupuncture business is only there until 2022.
Apologies.
So they,
I thought they'd renewed, but it says 15 years from 2007. You're right, yeah. So their lease is actually expiring in 2022. But is that a bad thing? Does that create some opportunity for repurposing perhaps part of that business?
I think it comes down to whether they're paying a current market rent. So if £30,000 per annum is the right kind of thing for 650 square foot, then you want to keep them there really for the yield. Yeah. But actually, if you thought it should be 40, then either renegotiate with them.
I don't think the rent angle is on there. I mean, I think this is interesting. First of all, you've got 150 grand's worth of rental income, and less than half of it is coming from Santander, which is actually good in terms of diversity of income. A lot of the income's coming from residential tenancies, which is nice. The thing about Santander, it's very unusual that they've actually renewed a lease in 2021.
Yeah.
They're in the process of giving them up.
Yeah.
And in some locations, they've even got 2 or 3 years remaining on the lease. They've packed up the store. They're carrying on paying the rent because they don't want to pay the staff and keep the branch open.
Yeah.
So that is an interesting sign.
Yeah.
But scroll up to the rents. Another thing I've noticed is what you tend to find with big companies. I mean, you've always got to look at, they've gone for a 5-year extension. Will they actually be there 5 years? And do you care if they go? And what I'm thinking is that sometimes big companies manage to get very low rents negotiated. If you look at the shop next door, the mom and pop acupuncture specialist, they're paying 38 grand for 650 square foot.
Yeah.
Double 650 square foot, that's 1,200 square foot, and double the rent, and it's still half the size of what the Santander have got.
So they're a quarter of the size, and they're almost half the rent.
Exactly.
Yes. Yeah.
So if Santander were to leave in 5 years, you've potentially got some action there in terms of rental uplift. And if you just go to the frontage, if you look at the size of the acupuncture, you could easily split the Santander into two shops. So I don't think the angle is to make a flat at the back in these sort of areas. But to basically make two shops.
The zone A in this particular Broadway would outweigh the value of any residential flat, right? But I think the other things that sort of drew me to this is, one, I operate in this area and know it particularly well. Two, they've closed down quite a few of the local Santander branches in the close proximity, but this has always been their flagship branch, and I'm not sure that they want to close this down. I think Santander want to still have some high street presence, and I think what they're doing is sort of just shutting down the smaller ones that don't have the footfall. But this particular Broadway has very large footfall, so I'm not sure they're going to vacate, actually.
Which is good news either way, because very large footfall means it's great if they stay. If they don't go, then split the shop into two. You know, a lot of the shops have limited shop frontage, and of course, you know, the thing that people need to remember is when you actually, if you want to split a large flat or a large residential property into two or more, you need full planning application. But you don't need planning permission to split a commercial property into two or more units, which is, you know, you're just good to go.
So I suppose the summary of it is, if Santander do decide to exit, you would just repurpose the building into three commercial buildings, and easier to rent them.
And there's a chance, I mean, even if you take it as 50-50 and you cut that square footage in half, there is a very easy chance that you could get £50,000-60,000 rental for each unit, because it's still double the size of the acupuncture.
That's true as well.
So there's a chance that you could take that 70 grand and turn it into 100 grand just by using, and it's commercial, so it'll be soundproofing, partitioning walls, and not a great deal of change to the fascia.
Well, as Omer pointed out, the Zone A action is going to be important there. If you just scroll down to the go-ahead plan, the block plan, you can see there's a service yard at the back.
Absolutely, I was just looking at that.
So the Santander might qualify for some Class MA action in making a residential flat at the back. And if you chopped the Santander Bank into the same depth as the neighbouring acupuncture shop, you'll still have two 38 grand shops minimum, plus a flat. I mean,
perhaps two.
Because remember that the access to the residentials above has to be from that service road.
Absolutely.
So it's already there. So it's now just a case of going in and looking at the arse of the building and seeing what can really be done with it.
I suppose the real sweetener would be whether you could build above, right?
That really is your cream on top. It
is hope value, but if you could, the values would be.
It doesn't look like they factored that hope into the price. I mean, whatever. I think this is going to sell for below 5%, maybe 4.5% yield. I think it will get that kind of price, and I still think that price won't be including maybe you do some kind of modular kind of build where you just kind of fabricate and plonk them on the top, right? And I think you'd still do well. And then we haven't even discussed this is an unbroken freehold mixed-use building. We haven't even discussed the idea of title splitting, because this close to that town centre, the sum of the parts will be certainly worth more than that, certainly.
So at a 5% yield, it should sell for in the region of 3 million, is what you're saying.
I think it's got 600 or 700 grand on top. I think, yeah, that would not be uncommon, and they obviously think so because this wouldn't be located at this point in the catalogue otherwise. But remember, VAT is applicable, so that will have to be dealt with if you are going to title split and sell off the resi and things like that. And they haven't put it down as a TOGC. So one of the things I would look for is to see if one of my pre-auction questions would they be open for the transfer of going concern, and then you just roll that VAT up, which would make the purchase process a little bit quicker and easier. Yeah. But good asset, solid asset, and that high street, because it's got a little market that runs down the middle of it sometimes, doesn't it?
Yeah.
So
Absolutely.
Yeah.
I suppose the only other consideration for this is lots of the Santander branches that have been through the auctions were guided quite significantly lower than this. We had some in at 350, 500, 900 million, that sort of level, and this is significantly more than that. So you're going to wipe out quite a lot of the commercial investors that are not at this level, that haven't got the funding to buy a £3 million commercial asset. So I wonder whether it will perform at a 5% yield on that basis, that there is less competition.
Well, I think the Santander one that jumps out of my mind was the one in Chelmsford, I think it was, where it sold for like 3.5%. It was ridiculous. But it was literally the Santander with storage above.
Yeah.
And that is very easy for a lot of SaaS people to get involved and go, right, I can put my money into this. Yeah. They're out of that. Yeah. But the small to medium REITs and pension funds, this is a nice little asset to be sticking in there. Because it's fully let, they hate any voids. So,
okay, we'll find out what that one goes for. Next up, we have got a property on a 14-year short lease in Surbiton. Next up, we've got a short lease property. This is one of Jay's selections. 14 years left on the lease, so that's almost an AST, isn't it?
Yeah, it may as well be. It may as well be. But I like this because this is priced where it should be. This is a good opportunity here, because the lease extension is going to be less here than if it was in a London Borough postcode.
Oh, you're right. 50 grand. Is that a stamp duty bill, or is that the price of the property?
Well, it's in fairness, it's probably going to be roughly maybe 50 or 60 grand to do the lease extension on this. So if you pick it up for 60 and you put 60 into lease extension, there is maybe 210 to 225 in resale around there for the 2-bed flat, because it's over the 2 floors.
Yes.
And that's actually quite attractive. And Surbiton is a nice area. Villiers Avenue is one of the main thoroughfares through there. I think this is a good opportunity. And I know we've talked about short leases in previous episodes where it looked quite hopeless. This actually looks like the person who's selling it has done quite a bit. And this one is one that I would argue, again, isn't a traded property.
Really?
No Section 42 has been submitted, right? Which is the first thing that you look out for. But one of the things that does raise a red flag is that planning has been submitted.
That's what I was just about to say.
But not granted. So
but that's a trader all over. Right? They're trying to create hope value that you can extend into this loft.
This is a bit of a 50-50 one. I think the pricing and the planning submitted but not granted, this puts it into trader territory. Yeah. And there's nothing wrong with trader territory. No. Myself and Omer are traders. But you want the point that we mentioned, the point of mentioning the fact that it's a trader is obviously they've likely owned it for less than 6 months.
Absolutely.
They've likely paid far less than they put it up for. And sometimes funders aren't fans of that. Yeah. So you have to consider, if it is traded stock, you have to be looking for individual investors or your own capital until you've owned it 6 months.
Well, I mean, the length of the lease makes it very difficult to fund anyway.
Yes.
But in the legal pack, if this is a back-to-back transaction, you'll see various things in the legal pack that have been redacted. And that will be your first telltale sign that this is a trader. But I feel it's a challenging one, because normally a trader would have put the Section 42 in there. Yeah. They've not done that. But then they've created this hope value that you can do something with the loft. and it's guided very low.
There are some mixed signals. The red flag that you mentioned about the legal packs and being blacked out, just so you're aware, this auctioneer in particular blacks out every single one. Not just like every single seller's name and seller's sister's name will be blacked out.
What's the purpose of that? You just go onto land registry and buy the title deeds yourself, £3 and
you create one more step.
Yeah.
And I think that's a good thing to do. Yeah. I think I would say about the hope value is, I think there's no hope value because they'll get the permission. Yeah. I don't think they'll not get the permission. It's what they're getting permission for and whether it's worth implementing. Yeah. Now, my belief is if you're extending space, it's got to be to create a new dwelling, an additional dwelling. All you're doing is making a 2-bedroom flat bigger. And to have a 3 or 4 bedroom flat above a shop with no outside parking and all the rest of it, you start to make it for a different market and they're not interested in that sort of property.
Before you even get to that bit, which is actually a really good point, is the cost of doing the loft conversion of value to...
Because you're not creating a separate dwelling.
And this is a high value area, right? So the cost of construction here and the cost of labour is going to be high. And a loft conversion on that type of building, you're going to be getting quotes of 40 odd grand just to put the loft on there.
It would be worth it if you're creating another dwelling.
But not to have a bedroom. And I believe the proposed loft conversion is to create, we need to look at the plans. Can you get 2 good-sized bedrooms and a bathroom in a loft above a shop? They're probably going to be small. They're probably going to be small, right?
The only reason to do this would be to create an HMO. Because then that's the only way to stack the value on a commercial basis and get the yield in that makes it worthwhile.
So what would the lease extension cost on this? What do you think?
I think you're between the 50 and 70 mark, but always add 10 for ancillary costs. Yeah. And even then, I still think it stacks.
I'm getting so many mixed signals as to whether this is a trader or not, because some traders would never go and put in a cheap new kitchen.
Why does it matter? I mean, if the deal works for what you want to do with it and you can make money on it.
No, it matters in terms of running the deal. Yeah. Because if you're looking to finance it, because there are people that will finance a 14-year lease. They'll do it if they know that if you've got the letters from the surveyor, the letters from the solicitor, you're already engaging, they will fund it because they know that the process has started and in the next 6 or 8 months, there's going to be another 125 years and they're protected, right? Because that process has started.
No, I get that in this particular scenario.
But if you are planning on doing that and you're buying it from a trader rather than a deceased estate, where the deceased estate has owned it for the last 30, 40, 50 years, whatever it is, if you're buying it from a trader, it becomes harder to finance.
The back-to-back element causes issues because the trader has exchanged without completed and therefore hasn't paid stamp duty. So the onward lender is going to see that they don't fully understand it.
They tend to get upset if there is a larger disparity between their client's purchase price and the previous person's purchase price. So the only reason to mention it, as I said before, is to just highlight the fact that there will be...
You're talking about resident... I mean, I've bought a few and they've ended up being from traders.
But commercial funding is much easier to get than residential,
commercial lending, and it's been no problem at all.
Absolutely.
But the kitchen... You're stacking complexities here with the short lease.
And remember, a lot of traders are sharp and they're savvy and they're looking to extract the maximum profit from the sale of an asset. But my question is about the kitchen. Do you see traders put kitchens in like that? So the mixed signals are...
What you would... A normal trader wouldn't whitewash it, which is what's happened. They wouldn't chuck in the budget carpet. That's what's happened. So someone here has obviously picked it up fairly well, thought, I'm gonna add some value by doing these bits. But actually, for me, there's a lot of mixed signals. I still like the price point. I think it's fair considering the risk.
You didn't answer the question. What's the lease extension going to cost?
I think between 50 and 70,000. Right.
Okay. Yeah. So flat above a shop, above a barber's as well. Is it a barber's or a hairdresser's there?
Hairdressers from memory.
So to title split that off, and it is already split, but to sell that would be very challenging for someone to get a mortgage above a barber's. But what do you think in terms of the resale value with an extended lease? Is there any money in it?
Oh, it's bakers, not barbers.
Oh, excuse me. Even worse.
It doesn't even help there, does it?
They're cooking now. Fire hazard.
There's big heavy ovens in the... So it's a short lease. It's above commercial, which is restricted for lending. Yeah. It's potentially traded. It's all of these other things. It is an absolute cluster of issues that could cause some problems. I quite like it. Because everything that is required to add value is all paperwork.
Absolutely.
It's all doable, it's all solvable.
Yeah.
And if you picked it up for 60 grand, I think you would very easily be able to double your money if you were to go through the process and solve the problem. The title splitting, I mean, it's already been done.
Yeah.
So you don't have to worry about soundproofing and doing all the other bits that are required if you own the freehold.
Yeah.
So yeah, it's problematic.
Yeah.
It's problematic enough to put a lot of people off, but there's definitely juice in that berry.
Yeah, absolutely.
And as you say, it's fixing problems with paperwork and power team as opposed to power tools.
Yes. And you could chuck a tenant in there in between, and you know.
Yeah.
So I think it's a fairly easy one to work on. Lots of problems, but I quite like it.
So tell us what you think. Do you think this is one to go for? Let us know in the comments below. If you've got any questions that we haven't answered, also let us know in the comments below. Smash that like button too. So on to the next deal that we're looking at. This is one I picked out. It's basically 5 studio flats in Kilburn. So what's going on here is you're pretty much buying a couple of floors above a shop on a long lease. It's all been split into 5 studio flats. You'd buy this as a bit of a yield play in London. You'll be getting 10% odd in terms of yield, and it'll probably go close to 10% yield. But with these sort of opportunities, there's a whole host of things that you need to look at, and it's usually down to whether the flats have been built in accordance to regulation, building regulations, and also planning regulations and HMO licensing and all of that. And if all of those are in order, at those sort of yields, it starts to be interesting because you're in the capital city with some interesting yields, because most buy-to-let yields in London are pretty much 3% these days. But provided building regulations, planning, HMO, all of that checks out.
This for me is a difficult one. It's leasehold.
Yeah.
So and it's 70 years.
Yeah.
And a lease extension, at the buyer's request. So that tells me it's not a trader. It's a nightly rate.
Yeah.
That's a concern,
There are 2 types of nightly rates. You've got the nightly rate, which is serviced accommodation, 90-day rule in London. That's one. Yeah. Then you have the emergency housing council contracts, where the nightly rate, you don't have the 90-day ruling because it's emergency housing. Now, I think that's what we're dealing with here. We're dealing with the latter. And if we're dealing with the latter, you can knock that 10% plus yield right down to 3% again because of all of the management and the aggravation. Because emergency housing, you're not dealing with Lord and Lady Muck who, their 18-bedroom mansion house isn't ready, so they need a temporary accommodation.
So this is let long-term to the council, so they will sort this out.
Yeah, so it's RPI through the lease, but is it an FRI lease? Are they fixing and repairing as they go?
It says here that a lease to a housing association for a term of 10 years commencing from 2021 at a rent of 53, which is less than the current rent it's producing.
Yes, but there is an option to let the building on a single RPI lease. So so you have to understand currently. Yeah. So just to clarify, currently the property is let producing £68,000. Yeah. And it's probably being managed, and all those management costs are causing will definitely cause aggravation. Oh yeah. But now there is a contract or a conversation in place to enter into a 10-year contract with a housing association for approximately 10 grand less.
Yeah. Which will take away all of the maintenance and management and headache.
If you were going to do it, you'd net that yield quite nicely. Yeah. But you still wouldn't be getting 10% because what's that, 8% on you? If you went with the housing association, it's not bad. Yeah.
I don't think it will sell unless it's very, very close to 10%.
It didn't sell last time it was offered, I don't believe. So
it's not one for me. Leasehold, no other real value add opportunity. There's no multiple exits. It's a one-trick pony, and for someone who just wants the yield, it could be a nice investment, and it's a nice postcode, but I don't think it's got enough to...
This is not going to go to someone who's doing this for the first time. This will go to someone who's an established room operator in the area and is adding this to their existing portfolio. And under those circumstances, it would make some sense. And I think those sort of people, because they're fewer, will probably get this at a decent price.
Yeah, I agree. I think if you're dealing with someone who already understands that the relationship between landlord housing association, and they're happy to take that cut in income for the lack of aggravation that comes with it, then I would think they'd be in a position for it. But I think they'd be maybe at the £600,000 mark, because I think at 58, I think it works. But I think this came down in value. The previous that was listed, I think it started with a 7.
Yeah.
So they're trying to find its value, and that's the beauty of auctions. Once you know something's been in once, and Barn and Marcus do a lot of stuff like this, where you see we haven't got the pricing right, the market's not at this level. Next auction it comes in 20, 50, 100 grand less, depending on what price it started off at. Yeah. So this could be a really good kind of pointer to go, look, let's see what happens with this one. Yes. If it doesn't sell, if it goes into the next auction, will it be at 575?
Yeah.
Then you're picking out a price point which is suitable for your investment strategy. It's a very interesting one to bring up.
Excellent.
So what do you think of this one? Let us know. Is it problematic for you? Would you even consider it? Let us know in the comments below. That's it for this episode. You can binge watch some of the previous episodes in the description below. Join us next time. Like as well, and tell us what you think. See you guys next time. Thank you, Jay, and thank you, Omer. Bye for now. High streets across the land are changing forever. Basically, there's an oversupply of retail premises. Shops are closing down, more are going to close down in the future. The government know this, and that's why they're introducing a light touch planning system which allows small developers to easily repurpose these buildings to residential use under a light touch planning regime called permitted development. Now, this is going to be the biggest revolution and the biggest change and the biggest opportunity for property investors that I've ever seen. And this is all coming into effect on 1st of August. So you need to know what's happening and what properties to look for to take advantage of these opportunities so that you can get in there and take that first mover advantage. I've got a 90-minute free masterclass to get you ready for August the 1st. Make sure you join me, click the link below. Whether you're a beginner or expert, we'll get you started.